couple called me in tears. Early 2024. They'd just closed on a house in Florida, Pasco County. $387,000. Conventional loan. Good credit. They did everything right. 6 months after closing, their insurance company dropped them, just like that. Letter in the mail, you're no longer covered. Have a nice day. So they started calling around for a new policy, and the quotes started rolling in. $12,000, $16,000. One came in at $24,000 a year. I'm going to say that again, $24,000 per year just for insurance on a house they already bought. That's $2,000 a month, on top of their mortgage, on top of their property taxes, on top of everything else. I'm Frank Mitchell, by the way, retired broker, 32 years in this industry, and I will tell you, when they called me, I didn't have good news for them. There wasn't much I could say. They'd already signed. The damage was already done. 2 choices. Pay the $2,000 a month and pray nothing breaks, or sell and eat a $40,000 loss after 7 months of ownership. 7 months. Now I want you to stop for a second. If you've got a list of states you're thinking about moving to, put it down. Watch this whole video first, because what happened to that couple in Pasco County is not a rare story anymore. I'm hearing versions of it constantly. I spent 30 years at closing tables across this country. I've sat across from hundreds of families, good, hard-working people who got absolutely buried by markets they didn't fully understand going in. And right now, in 2025, there are 4 specific states where the numbers just don't work for a first-time buyer. Not because the houses are bad, not because the neighborhoods are bad, but because there are forces underneath these markets that your agent is never going to bring up at the table. Most of them don't fully understand it themselves. And the ones who do, they still get paid when you close. So, I've got nothing to sell you. I'm retired. I'll just tell you what I know. 4 states on this list, and before you assume Florida is the only one, the second state on this list surprised me. And I've been doing this since 1991. Drop a comment if your agent has ever told you not to worry about insurance until after your offer gets accepted. I want to know how many of you have heard that line, because in my experience, it's one of the most expensive things a buyer can be told. Stay with me. This one's going to matter. Let me give you some numbers first. Across the entire country, property insurance is up 21% since 2022. That's the national average. That's bad enough on its own. But in the 4 states I'm going to show you today, insurance has gone up between 40 and 200%. Not 21. 200. I've been watching markets for 32 years, and I'll be honest, that number still gets me. That's not a bad year. That's not a market fluctuation. That's the floor falling out, and it's not coming back. But here's what actually keeps me up at night when I think about first-time buyers right now. Most of you are doing the math wrong. Not because you're not smart, because nobody ever taught you the right formula. You're calculating mortgage payment plus property taxes. Maybe you throw in a rough insurance estimate, and you figure that's your monthly number. That's not your monthly cost. That's your starting point. The real number, what I call the full carry cost, it's got several pieces most buyers never see coming. Your insurance at today's actual rates, not the placeholder your lender used. Flood zone reclassification risk. HOA special assessments that can show up out of nowhere, and I mean nowhere. And in some of these states, tax shifts that add hundreds of dollars a month in year 2 that weren't in year 1. In these 4 states, that hidden carry cost adds between $800 and $2,400 a month above what buyers are expecting. Read that again. $800 to $2,400 every month that nobody warned them about. Now here's something else most buyers are completely misreading. 3 of these 4 states saw inventory jump 30 to 60% in 2024, and I've talked to buyers who think that's great news. More options, more negotiating power, finally a chance. Stop thinking that way. When inventory spikes that fast, it doesn't mean opportunity. It means sellers know something. Cash investors, long-term landlords, people who do this with their own money for a living. They're getting out. When those people sell, you pay attention. Now, the 4 states, Florida, Louisiana, Texas, but only specific regions, not the whole state, and Illinois, each one for a completely different reason. And I'm going to go deep on each one. But before I do, there's something that happened in Southeast Texas in 2023 that almost nobody covered, and it's the thing that scares me most about all of this. FEMA reclassified flood maps in a stretch of communities outside Beaumont and Port Arthur. 1,200 homes. Overnight, they went from Zone X to Zone AE. Zone X means no mandatory flood insurance. Zone AE means your lender requires it immediately. These were people who bought years earlier, thought they were fine, woke up one morning owing an extra $3,100 a year, not because anything changed about their house, because somebody redrew a line on a map, and that can happen anywhere on this list. I've got a real insurance quote here from a home in New Orleans, 1,800 square feet, built in 2005. Nothing special about it. The number on this page is going to make your stomach drop. That's next. Let me walk you through these 4 states one at a time. Real people, real numbers. Because statistics don't hit you the same way a person's story does, and I want this to hit you. Florida first. Family bought in Cape Coral, $341,000. Nice neighborhood, good school zone. They did their homework, or they thought they did. At closing, their homeowner's insurance was $3,200 a year, about $267 a month. Uncomfortable, but manageable. 14 months later, their carrier sent a letter. The company was exiting Florida entirely. Not raising rates, not adjusting coverage, leaving, done. This was happening all over the state. Insurance companies were bleeding money from Hurricane Ian claims. Not just the immediate damage, but secondary claims that kept rolling in for 2 years after the storm. The math stopped working for them, so they left. The family started shopping. Quotes came back at $9,000, $11,500, $14,800. They went with $14,800 because that was the best they could find. Their monthly mortgage payment jumped $965, nearly $1,000 a month more than what they signed up for at closing. They can't absorb it, and they can't sell without writing a check at the table, because after fees and lost equity, they're upside down. 14 months, that's all it took. Now Louisiana, and this one hits differently. A teacher and a nurse. Combined income $112,000. Solid people. Responsible. They bought outside Baton Rouge for $278,000. Property taxes were low. They thought they'd found a deal. On paper, it looked like one. Here's what nobody told them. In 2018, Louisiana had 29 insurance carriers operating in the state. Today, it has 12. 17 companies looked at the numbers and walked away. When more than half the insurance market abandons a state, the ones left charge whatever they want. Because where else are you going to go? Their policy got non-renewed after 1 year. No claim, no issue. The company just decided the risk wasn't worth it anymore. So they called Louisiana Citizens. That's the state's insurer of last resort. The backup. The place you go when nobody else will touch you. The quote came back at $18,400 a year on a $278,000 house. That's $1,533 a month, just for insurance. I've been in this business 32 years, and I have never seen a ratio like that. And the worst part? They had no other option. That was it. That was the only policy available to them. Texas, and I want to be specific. Texas is a big state, and not all of it belongs on this list. I'm talking about Harris County, the Gulf Coast Corridor, League City, that region, first-time buyer. Put 5% down on a $410,000 home in League City back in 2022. Young guy, excited, thought he'd done his research. He looked at the listing sheet before making his offer. Property taxes listed at $7,500 a year. He built his whole budget around that number. What he didn't know, and what his agent never once mentioned, was that the previous owner had a senior exemption, a tax discount available to longtime elderly homeowners that disappears the second a property changes hands. His first full-year tax bill came in at $11,200. That's a $3,700 gap. Every year, forever. It wrecked his escrow account. And here's the part that really gets me. He got a letter from his lender, an escrow analysis, showing a $4,400 shortage, 30 days to pay it in full, or his monthly mortgage goes up $367 permanently. He called his lender in a panic, called his agent, and his agent said, and I want you to really hear this, I thought you knew about the exemption. He's a first-time buyer. How would he know? How would he know something his own agent never told him? That's the system. It's not built to protect you. I'm sorry, but it's not. Illinois. And this one's different from the others. This isn't about insurance. This is about taxes. Going in one direction. Forever. Between 2020 and 2023, $1.8 billion in net tax revenue left the state of Illinois. People relocated, businesses relocated. They took their income with them. And the municipalities left behind had to make up that gap somehow. They did it with property taxes. A home in a southwest Chicago suburb, assessed at $290,000. Nothing fancy. Normal house, normal neighborhood. Property taxes, $9,400 a year. That's a 3.2% effective rate. The national average is around 1%. This family is paying 3 times the national average every year. And in Illinois, it only goes up. There's no version of this story where it gets better. Now, I can already hear some of you thinking, okay, Frank, just avoid these states. Simple. That's not what I'm saying. People have jobs in these states, family in these states, real reasons to be there. What I'm saying is this: don't buy in these states in 2025 as a first-time buyer without understanding what I'm about to show you next. Because there's a mechanism underneath all 4 of these situations that almost nobody ever explains. And once you see it, you'll never look at a listing the same way again. 2019. I'm at an industry conference in Dallas. End of one of the sessions, I ended up in a side conversation with a reinsurance analyst. Not a broker, not an agent. Someone who works for the companies that insure the insurance companies. Different world entirely. And he said something to me that I wrote down that night in my hotel room. He said, "We're pulling back from 6 coastal states over the next decade. The retail market just doesn't know it yet." I looked at him and asked, "Why aren't buyers being told this?" He shrugged. That's it. That was his answer. A shrug. That conversation is playing out right now, in real time, in the exact 4 states I just walked you through. So let me explain the actual mechanics. Because once you understand why this is happening, you'll understand why it's not going to stop. First, climate risk repricing. I need you to hear this carefully. The insurance companies raising rates and abandoning these states are not being greedy. I know that's hard to hear, but it's true. For roughly 50 years, homeowners insurance in coastal and flood-prone states was underpriced. The math worked because major disasters didn't hit every single year. Companies collected premiums, paid out manageable claims, everybody moved on. That's over. What's happening now is 50 years of underpriced risk getting corrected in about 5 years. It's not a bad cycle. It's not temporary. It's a permanent repricing of what it actually costs to insure a home in a high-risk state. And it's concentrated, right now, in exactly the 4 states on this list. Second, and this is the part almost nobody explains, reinsurance. You know what reinsurance is? It's the insurance that insurance companies buy for themselves. When State Farm or Allstate takes on millions of policies, they turn around and buy coverage from massive global firms to protect themselves from catastrophic losses. When those global firms decide a state is too risky, they either leave or they triple their rates. That forces your local carrier into a corner. 2 choices: raise your rates dramatically to cover the new reinsurance cost, or exit the state entirely. 7 major insurers have exited Florida since 2021. 7. That's not a coincidence. That's the reinsurance cascade working its way down to your front door. And your agent doesn't explain this because, honestly, most of them have never once used the word reinsurance in a client conversation. I'd bet money on it. Third, the property tax assessment trap. This one specifically targets first-time buyers, and it's completely legal. That's what makes it so ugly. In a lot of states, long-term homeowners are protected by assessment caps. Florida has one called Save Our Homes. Limits how much your assessed value can increase each year to 3%. Sounds great if you already own the home. The moment that home sells, the cap resets to current market value on the day you close. I had a client, this was back in Tampa, maybe 2016. Sweet couple, first house, thought they'd done everything right. The seller was paying $4,200 a year in taxes, locked in years ago under the cap. My clients closed on that same house and their first year bill came in at $9,800, completely legal. Disclosed in the fine print somewhere on page 11 of the closing disclosure, and almost nobody reads page 11. Fourth, watch where the smart money is going. Cash investors don't buy on emotion, they run numbers. And right now, net outflow of institutional and cash buyers has hit multi-year highs in South Florida, the New Orleans metro, and Greater Chicago. They're not selling because prices are high. If prices were the only issue, they'd hold and rent. Easy money. They're selling because the carry cost math broke. And they saw it before most individual buyers did. When the people who do this professionally, with their own money on the line, start heading for the exit, that's not a signal you brush off. So now you know the why. You know what's underneath these markets. You know why it started. You know why it's not reversing. And maybe you're sitting there thinking, okay, Frank, but my job is in one of these states. My family's there. I already made an offer. What do I actually do? That's exactly what the last section covers. I'm going to give you the specific questions, word for word, that you need to ask before you sign anything. Questions your agent will not volunteer. Questions that could keep you from becoming the next story I tell on this channel. Let me tell you about a family from Ohio. Both working, good credit, 10% down, conventional loan. Did everything their lender told them to do. They got transferred to Tampa Bay for work. Found a house they loved, made an offer, went through inspection, got all the way to closing day. And at the closing table, they found out the only available insurance policy for that home was $19,200 a year, not $19,200 total per year, every year. They walked away. They had to. The number made the house completely unaffordable, but walking away cost them $8,500. Earnest money, inspection fees, application costs, gone. One phone call before they ever made that offer would have saved them $8,500 in 4 months of their life. That one gets me every time because it was so preventable. So here's what I want you to actually do, in order, before you sign anything. First thing, get an insurance quote before you make an offer, not after inspection, not at closing, before your offer goes in. Call 3 independent insurance brokers, not the one your agent recommends. Find your own. Get quotes in writing. And here's the number I want you to remember. If any quote comes back above 1.5% of the home's value per year, that's a hard warning flag. Stop and ask serious questions before you go any further. On a $300,000 home, 1.5% is $4,500 a year. If you're seeing numbers above that, the deal has a problem. Full stop. Second thing, pull the flood map yourself. Go to msc.fema.gov, look up the property. Find out what flood zone it's in right now, and then, this is the part most people skip, check whether a LOMA has been filed. That's a letter of map amendment. It tells you if the flood zone designation has been challenged or is pending a change. A seller can be sitting in Zone X today. No flood insurance required, with a reclassification already in process that hits the month after you close. I watched this happen to a couple in Beaumont, Texas. Closed in January of 2017. Reclassified to Zone AE in March. Mandatory flood insurance showed up on their mortgage statement 60 days after they moved in. 2 months. That's all the time they had between closing and a bill they never planned for. Third thing, for Illinois and Texas specifically, request the last 5 years of actual property tax bills, not the current assessment listing on the MLS. The actual bills, 5 years of them. And then call the county assessor's office directly. Ask them what the estimated reassessment will be after the sale. They'll tell you. It's public information. Most buyers never ask because nobody told them they could. Now, I want to say one more thing before I wrap up, and I mean this directly. If your agent ever tells you not to worry about insurance until after your offer gets accepted, find a new agent. That day. That one sentence has cost people I personally know everything they worked for. Their savings. Their down payment, their credit, everything. You deserve an agent who treats the full cost of ownership as part of the conversation from day one, not someone managing your comfort level so you stay in the deal. Look, you're watching this because you don't want to make a mistake. That's not weakness. That's smart. Use that. Call the insurance brokers yourself. Pull the flood map yourself. Request those tax bills yourself. Do the work before you sign. The worst thing that can happen is you find out the truth early. Because I've been on the other end of those phone calls. I know what those voices sound like. You don't want to be that call.